While 78% of investors lose money during recessions, Warren Buffett has made over $10 billion during economic downturns. What does he know that most people don't? What if I told you that the next recession isn't something to fear, but potentially the greatest wealth-building opportunity of your lifetime? Welcome to Oasis of Finance. Your financial freedom starts here. By the end of this video, you'll have a complete playbook for not just surviving, but thriving during economic uncertainty, using the same principles that have made Warren Buffett one of history's greatest investors. In the next 20 minutes, I'm breaking down Warren Buffett's recession investment strategy into a step-by-step playbook you can implement regardless of your portfolio size. While Buffett's wisdom is legendary, his approach can sometimes seem abstract. I've spent the last decade translating his principles into actionable steps for everyday investors like you and me. You'll discover the exact sectors Buffett is eyeing in 2025, the red flags he's avoiding, and most importantly, how to develop the emotional discipline that separates successful investors from the crowd. When I first discovered Buffett's principles, I was struggling to make sense of the 2008 financial crisis. I had lost nearly 40% of my portfolio while Buffett was making some of the most profitable deals of his career. That contrast sparked my journey to understand not just what he was buying, but how he was thinking. The framework I'm sharing today completely transformed my approach to market volatility. 5 components of Buffett's recession strategy. Today, we'll cover 5 critical components of Buffett's recession strategy. First, understanding recession psychology, the mindset that allows Buffett to act when others freeze. Second, his financial preparation framework that positions you to capitalize on opportunities. Third, the 4 specific investment categories Buffett targets during downturns. Fourth, a practical implementation guide for building your own recession watch list. And finally, post-recession positioning to maximize gains during the recovery phase. But before we dive in, let me address the most common question. Are we actually heading into a recession in 2025? While economic forecasts vary, what matters isn't predicting exact timing, but being prepared regardless. Buffett himself focuses less on economic predictions and more on preparation. As he famously said, predicting rain doesn't count. Building arcs does. Mastering recession psychology. Now, let's begin with the most crucial element of Buffett's approach, mastering recession psychology. Be fearful when others are greedy, and greedy when others are fearful. This famous Buffett quote captures the essence of his psychological edge. During recessions, fear creates what I call the fear premium, when quality assets sell at substantial discounts simply because of market sentiment, not because their intrinsic value has permanently diminished. This psychological advantage is perhaps Buffett's greatest edge. Studies show that during the 2008 financial crisis, the average investor underperformed the market by nearly 7% annually, not because of poor asset selection, but because of emotional decision-making. They sold at the bottom and bought back at higher prices. Buffett maintains his psychological clarity through 3 principles. First, he adopts a long-term ownership mentality rather than a short-term trading approach. He evaluates businesses as if he's buying the entire company for the next decade, not just trading stock certificates. Second, he stays within his circle of competence, investing only in businesses he thoroughly understands. During recessions, complex businesses often carry hidden risks that only become apparent under stress. Third, he insists on a margin of safety, ensuring the price he pays builds in a substantial discount to intrinsic value, creating a buffer against unforeseen challenges. I learned the importance of these principles the hard way. In 2020, when markets crashed at the beginning of the pandemic, I spotted an airline stock trading at what seemed like a bargain, 70% below its previous high. Ignoring Buffett's circle of competence principle, I invested heavily despite not fully understanding the airline industry's complex economics. When Buffett himself sold all his airline holdings shortly after, I realized my mistake. The stock fell another 35% before eventually recovering. but the recovery took years longer than for businesses within my circle of competence. To develop Buffett's psychological resilience, create what I call emotional circuit breakers, pre-commitment devices that prevent impulsive decisions during market turmoil. Before making any recession investment, ask yourself these 5 Buffett-inspired questions. Would I be comfortable if this position size doubled tomorrow? Would I buy the entire business at the current market valuation? Do I understand how this business makes money in both good and bad economic conditions? Would this business survive an extended recession without permanent impairment? If the market closed for 5 years, would I still be confident holding this investment? The real secret isn't just knowing what to buy, it's having the temperament to act when everyone else is panicking. Buffett's financial preparation framework. Now let's move to how Buffett prepares financially for recessions. Buffett's financial preparation begins with strategic cash management. While most investors view cash as a drag on performance, Buffett sees it as financial ammunition to deploy when opportunities arise. He famously held over $140 billion in cash before deploying capital during the 2020 downturn. I recommend a 3-tier cash reserve system for recession preparation. Tier 1 is your emergency fund, 6 to 12 months of essential expenses kept completely safe. This is an investment capital. It's security that allows you to avoid liquidating investments at the worst possible time. Tier 2 is your initial opportunity fund, typically 15 to 25% of your investment portfolio position to deploy early in a downturn. Many investors make the mistake of using all their cash too early in a recession, before the best opportunities emerge. Tier 3 is your deep recession reserve, additional capital you can raise through rebalancing or income sources if markets fall significantly. Buffett often increases his cash position as markets reach historically high valuations, preparing for future opportunities. The second element of Buffett's preparation framework involves debt reduction. While leverage amplifies returns in bull markets, it can be devastating during downturns. Buffett maintains minimal debt both personally and at Berkshire Hathaway, giving him the flexibility to act opportunistically rather than defensively during market stress. Consider how different investors fared during the 2008 financial crisis. Those with low leverage could focus on buying opportunities, while highly leveraged investors were forced to sell at the worst possible time to meet margin calls or debt obligations. What Buffett understands is that surviving a recession intact is your first priority. You can't capitalize on opportunities if you're financially vulnerable. To create your own opportunity fund, I recommend a simple formula based on your investment timeline and risk tolerance. For investors under 40 with stable income, allocating 20 to 25% of your portfolio to cash during late-cycle economic conditions is reasonable. For those approaching retirement or with less income security, 30 to 35% provides more protection and opportunity. The key is gradual positioning. Start building your cash reserve as economic indicators flash warning signs, not after the recession begins. I personally began increasing my cash position in late 2019 when yield curves inverted and corporate debt reached concerning levels. This disciplined approach enabled me to deploy capital in March 2020 when quality businesses were trading at once-in-a-decade valuations. Buffett's 4 investment categories. Now let's examine the 4 specific investment categories Buffett targets during recessions. The first category is essential consumer businesses with durable competitive advantages. Buffett's famous Coca-Cola investment during the market crash of 1988 exemplifies this strategy. Companies providing essential products or services that consumers need regardless of economic conditions offer both defensive protection and offensive opportunity during downturns. The key characteristics Buffett looks for include pricing power, recession-resistant revenue streams, low capital requirements, and strong balance sheets. Even in severe recessions, consumption of essential products declines far less than discretionary categories. For example, during the 2008 financial crisis, consumer staple sales declined by only 3% while discretionary spending fell over 20%. Companies like Procter & Gamble, Coca-Cola, and Johnson & Johnson maintained relatively stable cash flows despite the economic contraction. To identify these opportunities, examine historical performance during previous recessions. Look for businesses that maintain stable operating margins and revenue through economic cycles. Avoid companies that appear recession-resistant but carry excessive debt, as financial strain can negate their defensive characteristics. The second category Buffett targets is financial institutions trading at deep discounts. His investments in Bank of America and Goldman Sachs during the 2008 crisis demonstrated his ability to distinguish between temporarily distressed versus fundamentally impaired financial businesses. When evaluating financial institutions during recessions, Buffett focuses on tangible book value, deposit stability, loan portfolio quality, and capital adequacy ratios. He avoids institutions with opaque balance sheets or exposure to complex derivative positions that are difficult to value. The key insight is that market panics often indiscriminately punish all financial institutions, creating opportunities to acquire well-managed banks and insurers at fractions of their intrinsic value. However, this category requires the most specialized knowledge, and is where Buffett's decades of experience give him a significant edge over average investors. For retail investors without deep financial expertise, focusing on the highest quality institutions with conservative lending practices and diversified revenue streams is the safest approach. During the COVID crash, banks with strong digital capabilities and diversified revenue sources recovered much faster than traditional lending-dependent institutions. The third category is high-quality businesses facing temporary problems. These are companies with durable competitive advantages experiencing cyclical challenges rather than structural impairment. Apple is a perfect example. Buffett substantially increased Berkshire's position during market downturns, recognizing that temporary demand disruptions didn't undermine Apple's ecosystem advantages. The critical skill is distinguishing between cyclical and structural business challenges. Cyclical problems are tied to economic conditions and eventually reverse, while structural problems indicate permanent competitive disadvantage or industry disruption. To make this distinction, analyze whether the company's challenges are affecting the entire industry equally or represent company-specific weaknesses. Examine competitive positioning trends over multiple years, not just recent quarters. Most importantly, assess whether the fundamental value proposition to customers remains intact despite current difficulties. I use a temporary versus permanent impairment decision tree for evaluating distressed companies. Ask whether the problem affects the entire industry or just this company, whether it impacts the core business model or peripheral operations, and whether it requires a complete strategic pivot or simply riding out the cycle. The fourth category Buffett targets is infrastructure and utility investments. These businesses often face temporary price declines during recessions, but maintain regulated cash flows and essential service characteristics. Berkshire Hathaway Energy, which owns regulated utilities across America, generates consistent returns regardless of economic conditions. The unique characteristics that make these businesses recession-resistant include inelastic demand. People need electricity and water regardless of economic conditions, regulated returns on capital, and high barriers to entry. While growth may be modest, the stability and often inflation-protected nature of these cash flows provide both safety and opportunity during uncertain times. Implementing your recession strategy. Now that we understand what to buy, let's address practical implementation. How to build your recession watchlist and execution strategy. The single most important preparation step is building your opportunity watchlist before prices drop. During market panics, emotional clarity becomes difficult. Having pre-researched targets with predetermined entry points allows you to act decisively when others are paralyzed by uncertainty. I recommend creating a 3-tier watch list organized by conviction level and entry points. Tier 1 contains your highest conviction opportunities, businesses you understand deeply and would be comfortable holding for a decade. Tier 2 includes solid businesses you'd purchase at sufficient discounts. Tier 3 contains speculative opportunities that could offer outsized returns but carry greater risk. For each watchlist company, establish 3 potential entry points: an initial position price, a core position price, and a table pounding price where you would invest a significant portion of your opportunity fund. These price targets should be based on historical valuation ranges and your estimate of intrinsic value. While Buffett's valuation methods can be complex, we can adapt his approach using a simplified intrinsic value calculation. For stable businesses, take the average free cash flow from the past 5 years, apply a conservative growth rate based on historical performance, and discount back at a rate of 10 to 12% to build in a margin of safety. For example, if a company generates $1 billion in annual free cash flow with a 3% growth rate, discounted at 10% and adjusting for debt and cash, you can establish a reasonable valuation range. Then, set your entry points at discounts to this intrinsic value, perhaps 10%, 25%, and 40% below your calculated fair value. Once you've established your watch list and valuation targets, develop a systematic position sizing and entry strategy. Buffett rarely deploys all his capital at once, instead scaling in as prices decline. This scale-in approach acknowledges the impossibility of precisely timing market bottoms. I recommend allocating your opportunity fund into 3 deployment tranches. The first tranche, 25 to 30% of your opportunity fund, is deployed when initial price targets are met. The second tranche, 40 to 50%, is reserved for core position targets during deeper market stress. The final tranche, 20 to 30%, is preserved for exceptional opportunities that reach your table-pounding price targets. Position sizing should reflect both conviction and uncertainty. Higher conviction opportunities in essential businesses might warrant 5 to 7% portfolio allocations, while more speculative positions should be limited to 1 to 2% initially. Always reserve additional capacity to increase positions if prices decline further. My personal technique for managing entry points combines systematic and discretionary elements. I establish price targets based on valuation, but also require certain qualitative confirmation before executing, such as stable or improving operating margins despite revenue pressure, insider buying, or maintained dividend policies. During the March 2020 crash, I deployed my first tranche when the market declined 20%, focused on essential businesses like grocers and healthcare companies. My second tranche deployed at a 30% decline, adding quality banks and industrial businesses. The final tranche went to opportunistic purchases when individual stocks reached 50% plus declines despite maintaining operational stability. Post-recession strategy. Now let's address the final component of Buffett's recession playbook: post-recession positioning and recovery strategy. Knowing when to hold versus when to sell your recession purchases is critical to maximizing returns. Buffett distinguishes between structural holdings, businesses he intends to own indefinitely, and opportunistic investments made specifically due to recession-induced mispricing. His Bank of America investment represents the former, growing to become Berkshire's second-largest position. His Goldman Sachs preferred stock investment during the 2008 crisis represents the latter, which he sold after the recovery once it achieved his target return. To determine which investments to maintain long-term, evaluate whether the business's competitive position has strengthened during the recession, whether management allocated capital effectively during the crisis, and whether the fundamental growth trajectory remains intact despite economic challenges. I use a simple decision framework. Investments that maintain their competitive advantage, demonstrate effective capital allocation during stress, and still trade below intrinsic value should be maintained regardless of short-term gains. Conversely, companies that have reached fair value and face uncertain competitive positions become candidates for reallocation. Tax efficiency becomes particularly important during the recovery phase. Harvesting losses during the recession can offset gains during recovery, while thoughtful consideration of holding periods can significantly impact after-tax returns. Buffett is famous for his tax-efficient approach, preferring to hold quality businesses indefinitely rather than incurring capital gains taxes through frequent trading. For most investors, maintaining recession purchases through at least a 12-month holding period captures long-term capital gains treatment in most tax jurisdictions. For exceptional businesses trading below intrinsic value, the optimal holding period is often measured in years or decades, not months. The final aspect of post-recession strategy involves preparing for the next economic cycle. Buffett recognizes that recessions are inevitable features of market economies, not one-time events. The recovery phase provides an opportunity to realign your portfolio for long-term resilience. As markets recover, gradually shift from pure opportunistic investing back to systematic portfolio construction. Ensure sector diversification while maintaining overweight positions in businesses with structural advantages. Begin rebuilding your opportunity fund as valuations normalize, typically targeting 15 to 20% cash during mid-cycle economic conditions. Most importantly, document your recession investing experience, both successes and mistakes, while the lessons are fresh. These insights will prove invaluable during the next downturn, which may arrive years later when memories have faded. The most important lesson from Buffett isn't just how to invest during one recession. It's how to position yourself across multiple economic cycles, building wealth consistently while others are whipsawed by market extremes. Economic uncertainty isn't something to fear. With the right preparation, it's your greatest opportunity to build generational wealth. Thank you for investing your time with me today. I'll see you in the next video.